Now, so far we've done a lot of, I guess, finance. What about the accounting? Here are the journal entries. In the event the bonds sell at par, debit cash, credit bonds payable, like any other note that we've looked at. Debit cash, credit bonds payable. The bonds selling for a discount would be debit to cash for the amount you receive, and you debit the discount. Now, got to be very careful. The discount is a contra liability account. So when you look at bonds on the balance sheet, some companies might record this net instead of having two accounts. So the carrying value of the bond, the carrying value is the difference between the two. Carrying value is 369,113, but the two accounts are reported together, and that is a contra liability. It's a contra liability. So on the date you issue the bond at a discount, debit cash for the amount you receive, debit the discount, which is a contra liability, offsets, and bonds payable net, or 369,113. And for the premium is, if you like, an adjunct account. It gets added to the liability. So if you look at the premium account, bonds payable at par, and then the premium. So the bonds payable at par of 400, premium was 334,121. So when you issue the bonds, you're going to debit cash 434,121. You're going to credit bonds payable at par, and you credit the bond premium. And this is known as an adjunct account, or you add it. So of course here, the carrying value is equal to 434,121. And on the balance sheet, this is the way it looks. Okay, bonds payable net, or the carrying value. That's the way it would appear. So bonds at par, if it's got a discount, the discount is a contra, and if it has a premium, the premium gets added. And that's the balance sheet presentation. Premiums are adjunct accounts. They add to the liability. Discounts are contra accounts. They reduce the liability. Now, what we haven't seen yet is the interest. And as I said, I skipped the simple interest, something we've seen in the adjusting entry part of the course. Let's now look at what we need to do for bonds. So what we have to do is adjust the interest expense, unless, of course, the bonds are issued at par. If the bonds are issued at par, we do not have to adjust interest expense. If the bonds are issued at a discount, the discount increases the effective cost of borrowing. And if there is a premium, it reduces the effective cost of borrowing. So when you have a discount, the interest expense will be made up of a cash and a non-cash component. Added together, when there's a premium, there's a cash component reduced by the premium amount. What this does, it adjusts the nominal interest or the stated interest to the effective interest. What this is doing is adjusting the coupon rate to the market rate. Interest expense is always based on the market rate. That's why I gave you that last question, although we didn't use the clickers, but the last question was designed to show you that interest expense is in reality based on the market rate of interest. Now, the way we have to do this, and I'm going to show you how to do this on a calculator, but I'd like you to do it by hand as well, is amortization. And you could build, obviously effectively build one of these tables very, very easily on Excel. But I think the best way to do this is to work this out by hand first. Then we'll use the calculators. And if you ever want to build an Excel, you can. Excel table. What we're going to look at is the effective interest expense. And the effective interest expense, which you already calculated in that example, is going to be the semi-annual market rate multiplied by the beginning balance of the debt. The amortization, in this case, it's going to be discount. The discount amortization is really accrued interest expense. It's interest incurred but unpaid. Because when do you pay the discount? At maturity. That's when you pay it back. So it's really like any other accrued interest. And that's going to be equal to the effective interest expense. Remember, the effective interest is always what? Based on market. Minus the cash interest, the cash or the coupon interest. Cash or that's coupon interest. All right, so I'd rather do this by hand because, quite frankly, it's if you were going to build this table, you would do it with an Excel spreadsheet. And you will use the calculator, which I'll show you in a moment. I think it's much better, though, to work this out. Just a couple. I'm going to do a couple of periods for you. All right, the beginning balance, let's take the discount. The premium, you can try that on your own. But the discount, let's start with the discount. The beginning balance of the debt. Let me make sure everyone knows, just like double declining balance, it's the beginning balance of the debt. So the beginning balance of the debt is $369,113. The market rate of interest in this case, these bonds sold for a discount. The coupon was 8, market was 10, semi-annual was 5. So just as you did in that last question, you took the semi-annual market rate and multiplied it against the beginning balance of the debt. This is very, and by the way, you do this, everyone have a credit card, you do this every month if you have an unpaid balance. You take your unpaid balance, the credit card provider has a certain rate of interest that's locked in, you multiply that against your beginning balance, and that becomes your expense. Now, in the event that that was your credit card, if you don't pay anything in that month, what happens to the balance of your credit card? Goes up by how much? 18,456, right? If you don't pay anything, your liability is going to keep going up. I mean, you don't buy anything. You know, you just keep leaving that balance. All right, look, I think I have enough on the card, so I've got a very high credit limit, but I don't want to go to the 400,000 limit that I have. So I'm leaving it at 369, but I got interest, I didn't pay it, balance goes up. But you know what? Let me put in the minimum. So if you pay the minimum that month, your unpaid interest that gets added to your liability is $2,456. And what happens to the balance of the debt? You started with 369,113. You have interest that accrued, but you didn't pay it. It's 2,456. So the debt now goes up to 371,569. And that's exactly what you're seeing right here on the table. And by amortizing that discount, when you amortize the discount, we'll show you the journal entries later, but the discount drops to 28,431, and debt goes up. Notice that by amortizing the discount down to zero, you bring the debt up to what? Face value, so when you pay it back, that's what you have in your accounts. So the idea is to amortize the discount down to zero. Well, let's try one other. Next month, you don't buy anything else. You don't buy anything. But the interest was added. Credit card still charges you 5% on the unpaid balance. So now interest goes up to 18,578. That interest is added to the balance of the debt that you decide to pay in 16 again. So the unpaid balance, 25,78, gets added to the balance of the debt. And that should be 374, 147. So you notice that next period, you would, again, if I amortize it one more time by crediting that account, 2578. The balance of the discount goes down to 25,853. And the balance of the debt goes up $376. Any mistake? I'm sorry, 374. So the idea is to bring the discount down to zero, recognize the additional interest expense, and that brings the balance up to $400,000 when you have to pay. So it's really, and before we do this on the calculator, let me just show you like on a timeline. What's really happening here is that each period, so we started with 369,113. Going from time period 0 to time period 1, got 16,000 of the interest here. When you accrue or recognize the discount, So what happens is that every period, when you amortize the discount, you're bringing the debt higher and the interest expense goes up. Do the same thing next period. Go to period 2, and that would bring the debt up by 2,578. Brings the debt to 374, 147, and my interest expense here is 18,570. So my interest expense goes up each period, as well as the debt. And what happens along this timeline, if you keep going up to time period 10, what's left in the balance of the debt? At maturity, it's $400,000. Now, that is known as the discount amortization. Every period, interest goes up to reflect the higher market rate. It's above the $16,000. And the debt balance increases because it represents what? The unpaid interest being added on top of your balance. So like any other credit card or any other debt that you'll ever incur, unpaid interest gets added to the balance of the debt, and your interest keeps going up because you owe more at a constant rate of 5% in this case at the market rate. Now, I'm going to show you how to do this on a calculator and then give you the journal entries. First, any questions on the amortization process? You should try to do this. I wouldn't build this whole table by hand, but I would try a few more lines just to make sure you get the flow. It's always market rate against beginning balance of the debt, and the debt always goes up by that interest expense minus the cash interest. That's always the logic behind that. And it's like any other debt you'll ever incur throughout your borrowing life. That is, you'll always pay on an unpaid balance, and if the interest is accruing, but you're not paying the full amount back when it accrues, your debt goes up. Right, now, for the calculator, let me just show you how to do that. All right, first, I'm going to put this problem in again. So if I'm going to put the problem in again, it's going to be 400. Let me put it on first. That will help. Okay. 400 at my PV. I'm sorry, FV. 400 is the future value. I got 16,000 as the payment. 5 is I, that's the market rate. 10 is N, and I should get a PV of 369, 113. Now, in order to amortize this, I'm going to give you a couple of the keystrokes. I don't do anything until I get back to the document count. I think that's right. All right, so what I want to do is I want to amortize this. I'm on an exam. I'm only asking you for like 2 periods, maybe 3 periods. Don't do the whole table. You know, I can give you a 40-year bond sending out, and you're going to be there for 80 periods. You know, you don't need to. 2 periods, 2 periods. Okay? 1 in this case means next. So you're going to say, all right, I'm going to go to the 3rd period and hit 3. It doesn't work. 1. 1 means next. So here's what's going to happen. All right, so the first thing I'm going to do is I'm going to go down here, and I get the number 1. And I go to the gold key, F, and then up here it says amort. And that tells me that my interest expense is $18,456. 1 F amort will give you the interest expense that I had before, which I have here. $18,456 is my interest expense. 1 F amort. Now, don't jump and say 2 F amort because you won't get the right answer. Now what I want to know is what's my discount amortization. So if I want to know that, there's a key right here that says X greater than or less than Y. If I hit that, I get the discount amortization of 2456. 2456. And then finally, if I want to get the balance of the debt, which should be 371,569, you see there's an RCL. That means recall. I want to recall the present value. RCL PV 371,569. So I would practice using the calculator also, because on an exam it's very convenient to do that. So this, as I said, this calculator looks nasty and you don't want to use it. You want to use a for function, but as I said, it's got a lot of usefulness. So that is the way you can get it. I really want you to do this by hand a couple of times too, because you're going to get the feel for the flow of the discount. And I'm going to ask you to do I always ask you to do the premium on your own. I never really, once you do the discount, you can do the premium. We just need to do the journal entries before we go, and I want to make sure I do that. But before that, questions on calculator, on discount amortization. By the way, if you add this up, if you add up the amounts here, I'm going to show you. This is where all those calculations are coming from. But I want to go back for a minute. I want to show you that if you add this up, and this should work. I think I have the numbers here, so maybe show you the numbers. If you add this up, so there should be 160. Right, the cash interest, of course, has to be 160. Where's my other numbers? How can I find them? I know that this has to be, there's a 3, the right numbers for everything else. So this should be 30,887. And this should be 190,887. So the sum of the cash interest plus the discount or minus a premium is going to be your total interest. Now, on the exam, could I ask you, what's the total interest expense? Yes. You have to understand the relationship, because once again, I can give you a 40-year bond, semi-annual, and if you don't understand the relationship, you'd have to discount it for 80 periods to get the answer. So, what I would tell you is just understand that cash interest plus the discount, or cash interest minus a premium, is the effective interest expense. Cash plus discount or cash minus the premium will give you the total interest expense for the period. Now, for the journal entries, when you amortize the bond amortization is going to debit interest expense for the effective interest. It will credit the discount for the non-cash interest. But what is that really saying to you? Even though it is being credited as a discount, it's really effectively increasing the liability. So this is one case where I really don't like the the notation here, because it really should be reducing. This is another typo on their part. They really should be reducing the contra and increasing the liability. So this should be plus liability and minus contra. Because when you credit the discount, you're reducing that account, and it increases the liability, and cash is always the same. It's always the $16,000 for that cash. And the carrying value, so let me just stop at that point and show you that the carrying value at that point is the difference between the par value of $400,000 and the discount of $28,431. So the net carrying value or the net book value is $371,569, which is exactly what you see up on the screen from the calculator. So the journal entries will reflect what we have in terms of the calculator. So every period, you'd make the journal entry. So next period, what would happen? Let's take a look at, I could do it on the calculator, but I have it right there. What would be my total interest expense for period 2? $18,000. $578. That does not change. And I credit the discount for $25.78. Now, if I want to use the calculator again, here's the thing. If I want to go to the second period, notice I'm going to go to 1F amort again. Again, the 1 means next. It doesn't mean period. So if I do 1F amort, and I get the $18,578. $18,578. If I do X greater than or less than Y, it gives me the amortization of $25.78. And if I recall RCL, recall present value, I get the balance of the debt at $374,147. $374,147. All right, so again, I would like you to take a look at, make sure we do these problems. We're going to go over, I'm going to do one more thing before we go, just to show you one last aspect of this. I would try the tables, I would work on the premiums. I never cover the premiums, whether it's an intro or an intermediate. Just the opposite process. It'll lower the interest cost. Make sure you're familiar with the journal entries. Now, just one last issue, and that is, someone mentioned bonds being purchased before retirement, and that could happen. So let me, again, we're going to skip the premium case. Let me go right to that aspect for you. All right, if bonds are sold, I should say if bonds are repurchased before maturity, if you buy them back, there could be a gain or loss. If you pay more than the carrying value to retire a liability, there's a loss. If you pay less, there's a gain. So for example, if I have very high interest rate debt right now in the market, and market rates are lower, if I go into the market and buy them back, I'm going to have to pay a premium for that debt, and I'm probably going to have what? A loss. Now, I'm willing to take that loss. Why? Because I save interest out into the future. So that's one way to do this. I could also have a gain. If interest rates are going up, my debt is priced cheaper, and I could buy it back. So if I pay more for the debt, I have a gain. If I pay more for the debt than carry, I have a loss rather. If I pay less, I'm going to have a gain. Okay, so if I pay more, I have a loss, less, I have a gain. And very similar to the first question we had, one of the early questions we had today about selling a plant asset, you have to remove both the cost and the accumulated. when you retire debt, you got to remove both the par, the premium, par, and a discount. Right? So you either have a premium or a discount. So let me give you one last example. And let's take this illustration on December 31st, of 2014. We have a company, Smart Touch Learning, that first of all is going to retire its bonds at 95. The bonds have a par value of 100,000. Okay, so the bonds have a par of 100. So what the bonds look like on this company's books right now. Is something like this. The discount is sitting there at, is the balance of the discount, contra liability account. They retire the bonds at a price of $9,500. So par minus the discount is 96,919. They're buying the bonds back at 95, which probably means that market rates may be going up, making their bonds cheaper, and there'll be a gain in this case. So that if your bonds are on your books at 96,919 and you go out in the market and you pay 95 to retire them, it's a gain. Why is it a gain? Well, if you owed somebody 96,919 and they tell you, give me 95,000 to pay it off, you got a gain. And the gain is part of continuing operations. Now, in order to record that gain, getting back to the question I guess we had earlier today, let me go back, yes.
I was just going to say, wouldn't it be a debit for the bonds payable and a credit for the discount on bonds?
Yes.
Yeah.
We're going to do that. No, bonds have a credit balance. This is the balance now. It's not the retirement. No, that's the existing balance. So now, when we go to retire them before maturity, early retirement means I've got to remove the par. So I remove the par by the debit. I remove the discount by a credit. And that removes the entire carrying value. I credit cash for the amount I paid, and the difference goes into the gain. The gain is part of ordinary operations, and it would not be considered anything unusual. It's part of your normal operations. Or continuing operations, I should say, continuing operations. So it's not EBIT, but it's part of continuing operations. It's not part of a discontinued. So early retirement or early extinguishment of debt. You pay more, you got a loss. You pay less, you have a gain. You have to remove the par, any discount, or if there's a premium, you have to remove the premium as well. If you paid more than 96,919, you would debit the loss.